Mackenzie Johnston with Cattle News Central, bringing you your June 17th cattle industry headlines. Brought to you by 4T Ag Insurance. Colt Tritt, he is the owner and operator of 4T Ag. He is a one-man show. He himself ranches, so he understands all the risks that go along with the livestock industry. If your operation is not already enrolled in PRF insurance, go ahead and reach out to 4T Ag today and get enrolled. And if you want to learn a little bit more about 4T Ag and check out everything they have to offer, head on over to their website, www.4tag.net. That is the number 4, TAG.net. On Wednesday, MarketWatch reported the Federal Reserve increased its benchmark interest rate 0.75 of a percentage point in its most aggressive hike since 1994. The Fed's benchmark rate is now expected to end the year at 3.4%, an upward revision of 1.5 percentage points from the March estimate. The committee sees the rate increasing to 3.8% in 2023, but then in 2024, they anticipate that they will be able to slightly cut rates. After weeks of speculation, the rate-setting Federal Open Market Committee took the level of its benchmark funds rate to a range of 1.5 to 1.75%, the highest rate that we have seen since March of 2020, just before the pandemic. This aggressive approach stems from the Fed's goal to get inflation back down to 2%. They expect inflation to end the year at 5.2% and slow to 2.6% by the end of 2023. Keep in mind, as it stands today, inflation is at 8.6%, so they have quite a ways to go. In its economic forecast, the Fed expects the economy to slow to a 1.7% growth rate this year, down from 2.8% in March. They then expect the economy to pick up slightly to 1.9% in 2023. Through all of this, the Fed still claims that they do not foresee a recession, but I think it is fair to say, with all these numbers and everything going on with our economy and within our country, there is a recession right around the next corner. There is no doubt about it. CNN has reported President Biden sent a letter on Tuesday to major oil refinery companies calling for them to immediately increase supply. Along with this message, he is telling the same companies that historically high profit margins are unacceptable at a time when Americans continue to see fuel prices increase. In the letter, Biden explains that Putin is responsible for the price of fuel increasing. However, historically high refinery profit margins are worsening the pain. He goes on to say that the lack of refining capacity, which has led to unprecedented refinery profit margins, are standing in the way of his administration's actions to bring fuel prices down. Besides demanding that our country's major oil companies increase the supply of gasoline, diesel, and other refined products, the president also said the federal government is ready to use additional emergency powers to boost refinery capacity and output. My administration is prepared to use all reasonable and appropriate federal government tools and emergency authorities to increase refining capacity and output in the near term, said Biden. The energy industry is cautious about expanding due to fears of a repeat of 2020, when it overinvested in fracking and refining at a time when demand just up and disappeared. Because of this overinvestment, several U.S. energy companies, they went bankrupt. The energy industry also knows that regulations and consumer demand will force it to invest in cleaner energy projects. But then on the flip side of the coin, there are some within the energy industry that see an opportunity abroad, where energy prices are higher than here in the United States and capacity has been constrained as Europe attempts to move beyond Russian oil and gas. Nonetheless, our great President Biden, who has done his damnedest to constrain domestic oil production since he stepped foot in the White House, is now begging for domestic oil production to be increased overnight. Interesting how he is just begging now for that domestic oil production to step up to the plate, when for a year and a half now, since he has been in office, he has tried his hardest to stand in the way of domestic oil production. What a leader. What a great leader. So Biden's desperation to fix the energy crisis that he has created just keeps getting better, as Bloomberg has reported that the president will be visiting Saudi Arabia next month. Biden has high hopes that this trip will mend ties with the kingdom, despite his pledge to label Saudi Arabia as an outcast. During the trip, Biden plans to coax an increase in oil production, which would ease record high fuel prices. Saudi Arabia is known for their human rights violations, as we all know. Time and time again, we have heard news stories of them torturing, executing, and gruesomely killing their people, oftentimes in the streets. You say something wrong over there, you are done for. They are a terrible country through and through. Yet this is who Biden wants to get in bed with to fix our energy crisis over here in America. Absolutely ridiculous. This update is also sponsored by Ag Risk Advisors. They manage your risk so you can manage your operation. With the weather being unstable, there is no better time to look into coverage for your feed crops. The annual forage deadline is right around the corner. With their state-of-the-art technology and second-to-none customer service, you can be confident that your policy is in good hands. Ag Risk Advisors, risks averted, legacies preserved. National Beef Wire has reported on Thursday, Republican leader of the House Ag Committee, Glenn Thompson, introduced H.R. 8069, the Reducing Farm Input Cost and Barriers to Domestic Production Act. The bill requires the Biden administration to reverse its regulatory barriers to domestic agriculture production and provide immediate relief to families across the country. The bill would specifically provide relief from EPA's unprecedented actions related to crop protection tools, offer clarity related to WOTUS regulations, rescind the SEC's harmful proposed rule on climate-related disclosures, reinstate the 2020 NEPA streamlining, and require an economic analysis on the cost and benefits of GIPSA rules. Meeting Place has reported Wisconsin-based Fair Oak Foods is planning to build a $134 million meat processing plant in the Davenport, Iowa area. The plant is expected to bring about 250 jobs to the area. Construction of the 150,000 square foot facility will begin this summer and is expected to open in 2024. The plant is projected to have an annual economic impact on the area of $182 million. Fair Oak Foods produces a variety of protein products such as bacon, meatballs, and pork and turkey sausage for food service, national grocery chains, and quick service restaurants. Finally, according to a tweet from Chuck Grassley on Wednesday, the Senate Ag Committee will vote on the Fischer Grassley Cattle Transparency bill this coming Wednesday. That is all I have for you guys this morning. I hope you've all had a great week. Stay cool out there this weekend. It is supposed to be blistering hot here in central Nebraska. 104, 105 degrees. It's going to feel like a furnace out there. You guys have a great weekend. I'll see you next week.